At the end of 2025, the biggest individual tax overhaul in 30 years expires, and most freelancers have no idea it's coming. The Tax Cuts and Jobs Act, passed in 2017, is a temporary law. It was always designed to sunset, and when it does, the IRS's own projections show that roughly 62% of taxpayers will see their effective rate go up. But if you're self-employed, the impact is worse than that number suggests, because two of the provisions set to disappear were built specifically for people like you. Here's what you need to know, and exactly what to do before the window closes. What's actually expiring, and why freelancers are the most exposed. Let's start with the legislative context, because this law didn't just show up. Congress passed the Tax Cuts and Jobs Act in December 2017. It was the largest rewrite of the tax code since the Tax Reform Act of 1986. Almost every provision affecting individuals was made temporary, set to expire after December 31st, 2025, because that's how Republicans got the bill through the Senate under budget reconciliation rules. They had to cap the 10-year cost, so unless Congress acts, January 1st, 2026 is the reset date. Pre-TCJA rules snap back automatically. No vote required, no new legislation needed. The expiration is baked into the original statute. Now here's the exposure problem for freelancers specifically. W-2 employees losing TCJA benefits will mostly feel it through a smaller standard deduction and slightly higher marginal rates. That's real, but it's manageable. You, as a self-employed worker, lose those same things. Plus the Section 109 qualified business income deduction disappears entirely. That deduction exists only because of TCJA. It was never part of the pre-2018 tax code. When the law sunsets, Section 109A goes with it. That's three simultaneous hits: higher marginal brackets, a smaller standard deduction, and the loss of a deduction worth up to 20% of your net self-employment income. No W-2 worker faces all three at once. How your tax brackets actually change. Under current TCJA law in 2025, the top marginal rate is 37%. If the law expires, it reverts to 39.6%. That's the top bracket. But the changes that affect most freelancers happen in the middle of the bracket structure. The TCJA collapsed the old 25 and 28% brackets into a single 22% bracket and a 24% bracket. Pre-TCJA, a single filer earning between roughly $91,000 and $190,000 in taxable income paid 28% on income in that range. Under current 2025 law, the same income range sits mostly in the 22 and 24% brackets. When the TCJA expires, the 28% bracket returns. According to the Tax Foundation, a single freelancer with $120,000 in taxable income could see their effective federal rate increase by 2 to 3 percentage points just from the bracket reset, before you account for losing any deductions. Your actual exposure depends on your filing status and your total taxable income. A married filing jointly return has different bracket thresholds than a single return. Run your own numbers. But the directional reality is clear. Middle-income, self-employed earners take the sharpest marginal rate hit in percentage point terms. The Section 109A sunset, the big one. This is the piece most freelancers should be paying the closest attention to. Section 109A of the Internal Revenue Code, created by TCJA, allows owners of pass-through businesses to deduct up to 20% of their qualified business income. Freelancers, independent contractors, sole proprietors, and single-member LLC owners all qualify as pass-through entities. If you file a Schedule C, this deduction applies to you. The IRS reports that as of tax year 2021, more than 25 million taxpayers claimed the Section 199A deduction. The average deduction was approximately $9,200. At a 22% marginal rate, that's over $2,000 in tax savings, gone if the law expires. Here's the math at a practical scale. Say you net $80,000 in freelance income after business expenses. Your Section 199A deduction is 20% of that, so $16,000. At a 22% marginal rate, that deduction saves you $3,520 per year. In 2026, without TCJA, that deduction does not exist. You pay tax on the full $80,000, add in the marginal rate increase to 25 or 28% on portions of that income, and you're looking at a total federal tax increase of $4,000 to $6,000 on a single $80,000 Schedule C business. That's not a rounding error. That's a car payment every month. There are income limits and phase-outs for the Section 199A deduction, even under current law. In 2025, the deduction begins to phase out for specified service trade or business owners. That's most consultants, coaches, designers, and other knowledge workers. Once taxable income exceeds $197,300 for single filers and $394,600 for joint filers. If you're above those thresholds, your deduction is already partially or fully phased out. If you're below them, you're getting the full benefit and losing it entirely in 2026 unless Congress acts. My take is simple. If you are below the phase-out threshold and claiming the full Section 190A deduction right now, the expiration of TCJA is the single most expensive tax event you will face in the next decade unless you plan around it. The standard deduction rollback. The TCJA roughly doubled the standard deduction. In 2025, it's $15,000 for single filers and $30,000 for married filing jointly, adjusted for inflation under Revenue Procedure 2024-40. Before TCJA, the 2017 standard deduction was $6,350 for single filers and $12,700 for married filing jointly. If the law sunsets, the deduction reverts to pre-2018 levels, inflation adjusted. Most estimates from the Tax Policy Center put the post-sunset standard deduction for a single filer in the $8,000 to $9,000 range for 2026. That's roughly a $6,000 reduction compared to what you're using today. For many freelancers, this is actually where the math gets complicated. The doubled standard deduction under TCJA made itemizing less worthwhile for most people. You may have stopped tracking deductible expenses because the standard deduction beat them anyway. If the standard deduction drops back in 2026, itemizing becomes relevant again for more people. State and local taxes, mortgage interest, and charitable contributions could push you back over the threshold. But here's what most freelancers get wrong about this. Your Schedule C deductions are not itemized deductions. They come off the top before you even get to the standard deduction question. Business expenses under Section 162, your software subscriptions, your home internet, your professional development, your business mileage, reduce your self-employment income directly on Schedule C. That math doesn't change with TCJA or its expiration. What changes is the personal deduction side of your return. And if you've been sloppy about tracking itemizable personal expenses because the standard deduction covered you anyway, 2025 is the year to start tracking them again. In 2026, those records may be worth real money. What most freelancers get wrong about income timing. Here's the mistake I see most often when I talk about TCJA expiration with freelancers. They think about it as a future problem. It's not. It's a 2025 problem. If rates go up in 2026, then $1 of income recognized in 2025 is taxed at a lower rate than the same dollar recognized in 2026. That's not speculation. That's arithmetic. The right move is to accelerate income into 2025 and defer deductible expenses into 2026 wherever your contracts and cash flow allow. Can you invoice a long-term client for a Q1 2026 project in December 2025? Can you collect a deposit now rather than at project completion? Can you delay purchasing that new laptop or office equipment until January 2026 when the deduction offsets income taxed at a higher rate? These are not aggressive tax strategies. They are basic income timing decisions, and they are completely legal. The IRS cash method of accounting, which most freelancers use, recognizes income when you receive it and deductions when you pay them. That gives you genuine flexibility. A W-2 employee has no control over when their paycheck lands. You do. Use it. The one caveat, Don't let the tax tail wag the business dog. If deferring income means a client relationship suffers, that's the wrong call. But if you have natural flexibility in your invoicing calendar, the 2025 to 2026 rate differential makes it worth optimizing. A worked example, before and after. Let me walk you through a concrete comparison, so this isn't abstract. Meet a single freelance graphic designer. Let's call her Maya. She nets $95,000 in Schedule C income in both 2025 and 2026. Her only deduction beyond the standard deduction is Section 109A. In 2025, under TCJA, Maya takes the $15,000 standard deduction. Her adjusted gross income is $95,000 minus her half of self-employment tax, roughly $6,710, so about $88,290. Her Section 190A deduction is 20% of $88,290, approximately $17,658. Her taxable income drops to roughly $70,632. At 2025 rates, she pays approximately $12,200 in federal income tax. In 2026, if TCJA expires with no congressional action, Maya's standard deduction falls to approximately $8,500, the inflation-adjusted pre-TCJA level. Section 190A is gone. Her taxable income is roughly $88,290 minus $8,500, or about $79,790. The 25 and 28% brackets return. Her federal income tax climbs to approximately $16,800. That's a difference of roughly $4,600 on the same income. Same business, same effort, same revenue, just a different tax code. Now, what can Maya do about it? She can maximize her solo 401k contributions, up to $70,000 in 2025 for employee plus employer contributions, according to IRS Publication 560, to reduce her net Schedule C income before the Section 190A calculation even runs. She can pull forward Q1 2026 income into December 2025. And she can start tracking state taxes and mortgage interest again in case itemizing beats the smaller 2026 standard deduction. None of those moves require a law change. They require a plan executed before December 31st, 2025. Your action plan for 2025. Let's bring this together. The right moves in priority order. First, calculate your current Section 190A deduction. If you don't know what it is, look at line 13 of your 2024 Schedule 1. That number disappears in 2026. Build your 2025 plan around protecting it. Second, maximize retirement contributions now. Every dollar you put into a solo 401k, SEPI IRA, or simple IRA in 2025 reduces your QBI base, which affects your Section 190A calculation. But more importantly, it reduces your taxable income at the current lower rates. The solo 401k employee contribution limit in 2025 is $23,500. Total contributions, including the employer side, can reach $70,000. That's a significant tax shelter. Use it. Third, review your invoicing calendar for Q4 2025 and Q1 2026. Pull revenue forward where it's natural. Push deductible expenses into January 2026 where you can. Don't force it, but optimize where the flexibility exists. Fourth, start tracking itemizable personal deductions again. State and local taxes up to the current $10,000 SALT cap, mortgage interest, and charitable gifts. If the standard deduction shrinks in 2026, you may need those records. Fifth, and I'll say this directly, do not wait for Congress to fix this. There is active legislation being discussed, including proposals to extend or make permanent some TCJA provisions. But Congress has a well-documented habit of resolving these cliffs at the last minute, sometimes retroactively, sometimes partially. Plan as if the expiration happens. If Congress acts and your tax bill is lower than you planned, that's a good surprise. The reverse is not. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this breakdown was useful, subscribe. I put out new videos on freelance tax strategy and self-employed financial planning every week. And speaking of deductions, next week I'm covering the 20% qualified business income deduction in full detail: what it is, who actually qualifies, and why almost nobody claims it correctly. You'll want to watch that one before you file. Is there a specific freelance tax question you've been sitting on? Estimated payments, retirement accounts, home office, whatever it is, drop it in the comments. I read them all and build upcoming videos around what you actually need to know. This video may contain affiliate links. I only recommend tools I use personally.